Welcome to the Great Report, an exciting week, and I'm not just talking about the Indy 500 and the Pacers completely dominating the New York Knicks right now. I'm talking about this 20-year bond auction that happened late last week, and it's sending a lot of warning signs throughout financial markets across the globe. And while it seems a little bit kind of pretty macro, all these bond yields absolutely affect multifamily pricing because the risk-free rate, U.S. Treasuries, typically the 10-year Treasury is considered the risk-free rate in the world to base other investments off. If that risk-free rate changing is higher than it has been the last several years or higher than we're anticipating, that begs the question of where commercial real estate assets need to be valued at. So we're going to be looking at, again, more of the fundamentals. We're going to be looking at employment figures. We're going to be looking at opinions of Colliers, thinking about calling the bottom of some of the declines in commercial real estate. But is that too soon? Well, let's dig into all the details. You're not going to want to miss a second of this episode of The Great Report. Let's get into it. Welcome back to the report.
Hello.
Matt, how we doing?
Pretty good. Keeping up. Trying to keep up.
Trying to, man. It's been a great Memorial Day weekend. We're back in the saddle, ready to go, get people up to speed on what's going on, commercial real estate, the multifamily market. And as soon as you think you know kind of where the direction of travel, where we may be headed, where prices may be, trying to make plans, get things lined up, a wrench gets thrown in the gears. And, now there's some serious talk, not just about like higher for longer, as in interest rates where they are today, sticking around for a longer period of time. We're talking about maybe interest rates going even higher. And I think that really disrupts a lot of the plans of CRE investors thinking that this market may have bottom. So out of, again, some of the short-term concerns over this 20-year auction that didn't go as well as people had hoped, concerned about rising U.S. deficit and debt, this new big, beautiful bill that's passed Congress, headed the way to the Senate. Again, take politics out of it. It adds a lot of money to the annual deficit, and it's going to stack on trillions of new debt over the next decade with really not a really understanding of a way to pay for it all. And our creditors, the folks that are buying U.S. bonds, are wondering, what kind of fiscal shape is the United States going to be in? Do we have the capacity to continue to pay these bonds over the foreseeable future? And along with a downgrade in U.S. credit rating, asking folks, do they need to demand to be paid a higher yield of interest on those bonds in order to purchase them?
Yeah, I think that there is. I don't think that it's headed towards catastrophe just yet. For everything that I've heard, it's going to be hard to move things off the dollar and move the current paradigm of dollar dominance or anything like that.
Agreed.
And likewise, I don't think that it is necessarily sour grapes from other countries that are moving this bond thing. I think it is probably it's probably present in the Excel spreadsheets. Like, they have determined that the risk of the economy is great enough that the bonds aren't the release valve anymore, where they're now worried about it getting paid back. It's past the threshold of this point where the bonds are placed to buy it during times of uncertainty, and now it's increased to the risk is increased to the point where actually no, now we're worried about those bonds. And we talked about this before, but I don't think that it is necessarily a product of I'm going to get it back for tariffs. I think they're looking at things holistically,
Yeah, I think they're looking at the risk and saying,
risky.
And it's all relative, right? I mean, the United States, still, again, the world's largest military by a couple of times.
Yeah.
We have the most liquid markets. That's why the U.S. does have the dollar is the reserve currency, and there's no real alternative that's out there because not only do we have relative stability and strength and innovation, it's just we just have the most liquid market. We have we have so many citizens that are using the dollar.
It's not like we're going to blink and all of a sudden the Chinese yuan is the currency of favor.
And I mean, another contender could be like the euro, but still just the European Union itself compared to the United States, is not as strong, and just it is a comparison, but still, all things being relative. Okay, the United States, it might not be perfect and could do things better, but relative to all the other options, it still seems like the best bet. And a lot of this probably is relatively short term in nature.
It's just less of the best.
Less of the best. Exactly. Now that that being said, I mean it is all relative, and you do have to look out over the next decade or two and saying can we afford this level of spending? There's also the conversation of we can look at debt to GDP, but also if we look at our debt to assets, if you look at the balance sheet of the United States, there's been a good amount of conversation about this. It's not as bleak of a picture because I mean the United States has trillions upon trillions of assets, hundreds of trillions of dollars worth of assets from all of our land to everything. Now, how to monetize that is a completely different question, and that's can be a quagmire. But again, it's just asking additional questions, and just the rising level of uncertainty, which has been a theme over this last year, is leading to a little bit more of a risk premium right now. And so where that comes into play, and I want to shift to this Collier's article, because this is taking a little less of a macro approach, just looking at commercial real estate, but taking some of that larger bond story kind of out of it, which is a newer story relative to when this piece from Collier's was published. But it is two forces kind of moving in the opposite directions.
I would say, to be honest, like this article was a little bit dispiriting to read, because near the end of 2024, that was when we were first hearing about potential market bottom in the commercial real estate. And we heard so much about that. And now we're halfway through the year, and we're still reading about this market bottom, which means it's still being discussed, which means it's like still there has not been a very observable increase. Like it's not like we're not sure about recovery right now. We're still talking about, is it bottom, is it not? And what I liked about Collier's is it gives us a range, and it gives us from multiple sources. It's not just their own analysis. It's talking from it's Green Street and CoStar. They use different data sources to give this data, and it does look like retail has passed the threshold of it's not losing any, but just behind that is industrial, where there is some question about there may be one source that says industrial is right on the line of has it bottomed, and then multifamily is just behind industrial, where there may be one or two sources where they say it has a small amount of valuation decrease, but all of them think that, but on the whole, they think that values are recovering.
And so we're looking at a year-over-year value change, at the kind of different commercial real estate asset classes, and Matt, you're right on. Basically, retail and industrial, there's kind of a range, basically from 0 to positive. But multifamily, there's still some sources that have year-over-year declines in multifamily. But hospitality is faring a little bit worse. With about kind of right in the middle. Some sources have year-over-year declines. Some have some positive traction. Office, basically, it's negative 10 to 0%. Change
still hasn't
still hasn't recovered.
The most optimistic take is that it's barely over the 0%. Man, it's crazy how much office now. There are more. I keep reading these articles about the financial services sector is powering the return to office, but look at these values and they're not doing well.
Well, I think that there are people returning to office. There are people buying offices, but there's it's all new office space. It's new office buildings or newly renovated, really, really nice space. And there's a lot of old office that's trading for, pennies on the dollar. So when you look at that average, you got some stuff that's probably maybe at par, maybe even increased in value a little bit based on their new leases that they've signed. But then there's stuff that's worth half or less than half than it was worth. So that's it's averaging out.
I'm not sure also the typical length of lease for offices, if it's 5 years. Well, it's been 5 years since the pandemic, so that may make it a little bit of a longer tail in terms of that decline of demand.
And that's a really good point also, and it's a different story for office relative to multifamily, is that office does have these longer tail of leases that are expiring, and a lot of companies who, maybe they were in in the middle of their lease during COVID, and maybe some time has gone on and they've made some changes in how they think about the whole work from home situation, but they're coming up on a period of where they're having to make that call of, hey, do we need as much space, or do we be more strategic? Maybe we have the same amount of people, but we need less space, or do we need a different kind of space? So all those rollover questions are going to be coming up, and time flies. It's a good point. I mean, it's 5 years since COVID, since 2020, and so over the next couple of years, most of those leases that had been signed several years prior are going to start coming due, and a lot of those leases are 5, 7, 10-year leases. So the next 5 years it's not like all the pain is through an office. There still could be some, especially these older buildings, that there's just no real interest in working out of anymore. Yeah. It's either like, let's just like work from home and out of a WeWork, or if we need a physical space, let's take half the footprint, but let's make it really nice. Let's make that space where our clients are going to come. We're going to go for meetings and all get together, but we don't need like fancy cubicles for everybody.
Yeah. Yeah.
So
no, true. But on the whole, like, so we're kind of, talking about the lower end, but on the whole, like, this is an optimistic take on the commercial real estate market from Colliers, saying that the market is close to bottom. It's on the way up, even though, like, I'd like to have read about an unambiguous recovery in January. I guess it's better than not that it's happening right now from Colliers.
But your earlier point, though, I'm gonna throw a pen at you. Your earlier point, though, is that it's important to acknowledge that we're not through it yet.
Yeah.
And that there were articles from last summer in 2024 for calling point. That we're at the bottom. Yeah. And that they were seeing some cap rate compression mid 2024 last year. But now we are in the middle of Q2, approach, halfway through Q2-ish. And there's still calls for in articles about, hey, maybe we're still going through this bottoming process. Yeah. It has the optimistic kind of spin on it, as in like, hey, we're bottoming. Maybe now is a time to get into the market. But the reality is that the fog of war is still present. We're not really sure where pricing is, and there's not clarity on whether prices are going up or they're still going down.
Yeah, and that's why I actually thought that this final paragraph of the article here had some interesting points. Yes, it had the typical optimism, like act now kind of, and maybe think of Colliers when you're buying your real estate. But this is, I'll just read out and then share my thoughts a little bit. It says, with tremendous capital backstops, private equity real estate investors should begin to come off the sidelines and take advantage of shifting price momentum. It's not uncommon for major institutional investors to see multiple quarters of price increases before re-entering the market. While uncertainty remains, real estate fundamentals should continue strengthening, provided the economy maintains job growth and spending holds up. This dynamic will lure capital from the sidelines, reinvigorating investment sales activity and in turn pricing. So in short, things are getting better, they say. Big investors haven't jumped in, and there's opportunity for smaller investors like non-institutional. Yeah. I will add, however, and this is what we were talking about beforehand, that these institutions aren't exactly slow-moving behemoths. Like they're not like they are slower moving maybe, but like they can act when they want to. And we have been covering large acquisitions from places, throughout this past year. But I also think at the same time, like institutions aren't way off base in saying that it's a little bit of a dicey market. We just
they're a little bit safe. Yeah, a little bit safer.
So it's just they have a different threshold for risk, and it also explains the reticence of risk-averse investors. That like this idea that it's questionable that the CRE is bottom. Like, well, yeah, like things are still being hashed out. The same uncertainty, however, that is like holding back these institutions, and Colliers notes like this is the time private investors could find a real big deal if they know enough about an asset, or if they're confident when others are cautious, like the old kind of Warren Buffett quote. And like, to bring it back to multifamily, I think from our perspective on the Gray report, I think multifamily is worth being confident about if you've got the right property in the right place, right? But like there are places where you can be fairly confident in the multifamily market, and that might cut through some of the uncertainty. Whereas there are also markets, obviously they're specific assets, but I'm thinking about multifamily markets that are way more uncertain than others that may make it like on the whole, it's a little dicey. But if you're going to constrain yourself to a certain select amount of markets or a select region, you can be pretty confident about multifamily investment.
Yeah, again, like, as we've said in the past, if you have a mid to long-term outlook, you can be relatively comfortable. But even if you can be comfortable and confident in the fundamentals, you still don't want to buy a 5 cap when that same asset is going to be, with the same fundamentals, should be or will be trading at a 6 cap.
Yeah, and I also don't. I think I can
You don't
get,
overpay.
Yeah, yeah. And I also can get lost in saying, like, oh, it's all about where you go. Like, I think that covering some of the nationwide movements that we've seen and the trends that we cover on the national level, those happen across all of the markets. All the markets are feeling, this different interest rate pressures or something like that. But it will help you if you do have, like, if you can find that confidence in the market as a whole nationally, then you go to a specific location, specific region. I think that'll help. But
Yeah.
if it's office market, I don't know if I don't know if it's a good place to go.
That's true. It's tough, and this last paragraph here kind of mentions it. And while as uncertain as things are and volatile as things seem, the underlying economy is still like not bad.
Yeah.
Unemployment is still low. There's wage growth in the economy. We're getting a ton of corporate earnings that are very positive.
Yeah.
We're getting ready to talk about REIT, their earnings call from the first quarter. Extremely positive. That's not just random apartment fundamentals. That's consumer fundamentals that are baked into all that also.
Yeah.
So it's tough to say because there's arguments that say, going back to all this debt and deficit, that we can grow out of a lot of this.
Yeah.
Maybe that's overly wishful thinking. There's also an argument, relative to interest rates and inflation and all that, is that we haven't even seen hardly any of the impact of AI in productivity and technology, and the absolute deflationary impacts that technology has. And we saw that over the last cycle of where there was a ton of economic growth, but we don't have any inflation. We kind of started in the inflationary cycle relative to COVID, relative to supply bottlenecks, and then
This pre-COVID, you mean?
Well, I'm saying, pre-COVID we had very little inflation, but a good amount of economic growth.
Yeah.
A lot of that had to do with deflation relative to technology.
Yeah.
Then we kick-started inflation once again, mostly because shift from goods to services and services to goods, and the supply bottlenecks, and toilet paper on the shelves.
Yeah.
And then just the perception, wages going up, and everything rising, relatively short term. But so talking about, all right, well, now we're getting back to normal where interest rates are always 5%, and we're in this higher for longer period. That all could very well be true, but I think we're forgetting, again, it's not like nothing else has changed since the 70s and 80s. We have this huge impact from technology that is highly deflationary.
Yeah.
I think that we're all now starting to understand how AI can be extremely impactful. It's not flowing through to the economy universally.
Yeah.
But I think that unless you're really living under a rock, I think it's pretty clear how it can make us all a little bit more efficient.
Yeah.
And so there's other counter narratives to higher rates, inflation, all of this, and just again it goes to show that again it's surprising us that the economy can sustain itself and can keep going.
Well, even apart from the discussion of AI, we've spent the better part of these past 5 years recovering from the pandemic, and I think that the hyper growth around like 2021 and 2022 was a little bit of a mirage, or it did seem like it was so quick. It wasn't like the sustained amount of growth that we typically saw. For the past 5 years, we've been recovering from this from a pandemic. I know that we've had that super inflationary period, which should have represented like, oh, the economy's better now. But I think that was I don't think that it was everyone was happy during that time. I don't remember ever. I think there may have been like 3 months where people were actually happy.
The free money made some people happy.
It did make some people happy, but it didn't last very long.
Sure,
even when it was happening, I was like, this can't be right. Like this is going to come to an end. It came to an end relatively quickly, and I don't think it came to an end long enough for people to regain the confidence that they had lost during the pandemic, and the confidence that they never really regained post 2008, 2009. There's still this lingering feeling, and I think it's still lingering right now, but in the midst of that, we have really been recovering for the past 5 years. We haven't been doing nothing, and it's not like we've been, frittering it away.
Certainly built some apartments.
So yeah, we've built a lot of apartments, and I don't think that there has been this exogenous effect, just like the bottleneck of supply or like the subprime mortgage crisis. There is this underlying stability here that I'm just waiting for some government clarity that we could move forward and not just
government capitulation, but it's not bad enough.
Don't call it capitulation. Don't call it that. Then it's not an ego. I want them to feel good about.
They don't have to know. So this is why it's tough. Because you've got all those good things, but we also delinquency rates are up. Multifamily loans. CMBS. Agency loans. Delinquency rates are up. Some delinquency rates on some consumer credit stuff is up, but that seems like it's always elevated, to be honest. So it's hard to find a North Star, and I think the data is conflicting also. And so it takes a little bit of intuition to kind of point right.
And that's the big question I have too. Is like, all right, we heard all of these nightmare scenarios about empty shelves and high prices, and we haven't seen it yet. Once we do see those, maybe that's going to be maybe that'll have an effect. But right now, it still is abstract. I still haven't seen prices jump up dramatically, and I'm waiting. Maybe it will happen, but maybe they've already bought the next shipping container, and it's going to be fine.
Goldman Sachs just came out with a report a couple days ago saying that the impacts of tariffs on inflation is going to be pretty minimal.
Yeah. So
one we don't know. Just while we're here, Brittany, want to come in and say hello? So for those of you listening to the show, my daughter Rooney is at the office at the Great Capital headquarters here in Indianapolis. She's finished up with school on Friday, and she's at the office with her dad hanging out. Rooney, you want to say hello?
Hi.
Tell everybody your name and what you've been doing today.
My name is Rooney, and I've been working with my dad.
Do you have any opinion on interest rates and inflation?
What does that mean?
I know it's tricky. We haven't had the interest rate talk just yet.
Yeah.
What do you think about apartments? What do you know? What are we doing here at the office?
You're doing YouTube videos. You're working, and you're working on your computers and.
What do we do here at Great Capital?
You sell apartments.
Yeah, we lease apartments to people. Yeah, is that fun to help get people get houses?
Yeah.
Yeah, that's awesome. All right, thanks, Rooney. Say bye to everybody.
Bye.
Okay. All right, thanks, Rooney. All right, where were we, Matt?
Yeah, just kind of general uncertainty. Is there a way to see our way out? Yeah. We're talking about have we recovered at all in the past 5 years? Is it better now than it was in the moments immediately after the pandemic? Because that's when things really kicked off. But like you said, there are some estimates. What was it? I forget what source you said, but it was
Goldman.
Yeah, Goldman Sachs saying maybe tariffs won't have an impact.
There were huge tariffs before the weekend, Memorial Day weekend, that were announced, and then they've basically been canceled over the we So again, someone please explain to me even where we are.
And I wonder if every time that happens now, because we talked about this before, the threat of tariffs is only really going to be listened to if you kind of hold fast to that. And now, because we have seen so many, I don't call them capitulations, I say changes.
Deals. There's deals.
Strong, rugged deals that result in lower tariffs. That's what I want. The strength of lower tariffs. That's what I would love.
Yeah.
But no, because of so many shifts in there, then maybe the markets, the economy in general, is saying, all right, it's kind of looking past it and saying, no, there's going to be a reversion, and things are going to end up a lot more stable. We're going to ignore what he says now because the administration may say something different in 30 days. I think
you'd have to believe that at the end of the day, like at some point, over a short term, not even medium or long term, they want a return to stability. And there has to be this vision of we've got a period of time where we can bull in the China shop, break some stuff, get some deals, but then we got to clean it all up, and it's got to be smooth sailing. Get this tax bill done, extend the tax cuts, and try to let the economy grow.
Yeah.
if you don't send the economy into a recession.
Yeah.
Which honestly, I think might be the healthiest thing that the economy really needs. Like I think it wouldn't be fun for anyone. It would be tough for our business. It would be tough for almost all businesses. But I do feel like the economy needs to reset. Going back to these multifamily deals, we've got all these zombie multifamily deals that are out there. They're worth less than the debt or just the value of the debt. A lot of that needs to set. We need a lot of these deals to clear the market, and we need kind of a point of, there's no more extensions.
I know.
The money's gone. The money's dried up. You need to pay it back. And so if you're underwater, and then we can reset. There would be a lot of pain for across the income spectrum, across demographics. I think it would be less pain, though, have a lot in the short term than just this extended, drawn out slugfest.
Yeah.
But no one wants to take that. I don't really want to take that medicine. I'd love for the soft landing and fundamentals to return and just cash flow to just continue to increase.
Yeah.
But man, to get like the good deals, and again, not just they're linked. For the economy to start making sense, for there to be appropriate risk premiums on opportunities. For interest rates to be a little lower than they are today, for people to be able to afford to buy their own home, to have inflation finally be fully under control so we can anticipate what we're going to be spending over the next couple of years. A recession in the short term would be probably the best thing to achieve all of that.
Yeah.
I don't want that, though.
Yeah, I don't know about, I'm not certain about recession, but I do wonder, and I was talking to people over the weekend about, there's, I don't know how likely it is, but there is a discrete possibility where we could see housing market or home values go down. And they've been going up, like a juggernaut for so long. And it just seems like with home sales activity down, with the cost of home ownership, especially compared to renting, going up so high, and something's got to give. On the other hand, the job growth and the kind of wage growth made some slight improvements compared. So
I was
made
going to
home ownership
say
a little bit easier. So who knows?
So I was going to say later on in one of these National Association of Home Builders pieces, it discusses essentially, affordability has increased slightly over the last month or so because we've had some real wage growth but also single family home average price has declined slightly.
So there you
just
go.
Slightly enough. Again, not in a huge way, not for anyone to say, there's been a crash in the home market.
Yeah.
But in some markets like Florida, which is more of a Florida story, there's been a lot of price declines. But then from the affordability factor, we've seen, how wide a spread between renting and buying a home. And, you'd think it could be due for a little bit of a correction, but there's so few houses out there on the market, and the millennial demographic kind of that peak age, the few of them that can do have the money.
What scares me
homes.
is that all this sitting and waiting is like building up pressure, and that pressure is going to lead to like some kind of a sell-off or something. And I just, I don't know about the home buying and home selling dynamics in that way, but there has been, you can see since interest rates have gone up, home sales activity has just plummeted, and it's like below pre-pandemic levels.
Yeah.
And you think that, oh no, buying a home in this market, it's crazy. Well, yeah, it is crazy, but there's not a lot of people doing it. And so it's just like that means the question mark's so much bigger because there hasn't been enough price discovery.
Just the question is, all those people who locked in 2-3% interest rates, why would they ever sell unless they lose their jobs?
Yeah.
All right, Matt, let's move on, talk about some of the recent REITs, their earning calls from the first quarter, very strong performance. Again, talking about, are we entering into, a recession? Is the economy moving the wrong way? Well, when you look at how the largest apartment REITs did this first quarter, it goes to tell a lot about the strength of not only the U.S. economy, but the multifamily sector in the incredible demand that we're seeing, leasing activity, good occupancy, and we're still getting through, a 40-year peak in new supply. So, if this is the way the apartment industry looks, getting through all of this supply, man, I want to see in a couple of years when we have no supply coming online.
I wonder a little bit now. I don't think that these REITs can, because we're talking about REITs earnings statements, right? Is this what it is?
Yeah. They
so-
give a little report, talk about what they earned over the quarter.
Yeah, I don't think they can necessarily pull all of their punches. Like they can't lie to their to their shareholders.
They're not supposed to.
They are
I think
responsible.
the SEC might have something.
Yeah, exactly. So, but they do, I'm sure they like spin it a little bit. However, if you read between the lines, my thought is that their earlier expectations were that Q1 would be a little bit more subdued, and now it's kind of normal.
Bingo.
Yeah, because
just because like most groups are, when they did their budgets, they were like, well, we got completely like raked over the coals in 2023, 2024 wasn't that great. We're going through all the supply. Okay, next year's budgets. Oh, we're not gonna make any money next year. Bring all the budgets in line, and then like we beat we beat our budgeted numbers, but they weren't just. A lot of these numbers are not just budget numbers. It is NOI growth. Now it could be off of some negative NOI growth, but occupancies, generally are healthy, and there's enough positive KPIs. Because I had the exact same thought, but unless they are absolutely cherry picking some real selective data, there's enough in here to say that things are moving in a very positive direction. And it's not just one. We're talking about basically all the major REITs. Unless there's some,
Avalon Bay
collusion.
Revenue was slightly ahead of plan. Essex Property Trust say things have exceeded expectations. Equity Residential exceeded expectations. Camden Property Trust exceeded operating expectations. MAA also says things have exceeded expectations, and UDR has had stronger than anticipated same-store revenue. So there's all this about what they're anticipating, what they're expecting, and how things are better than that. That's good news, especially considering that their expectations were probably set in Q4 of 2024, which was before the current uncertainty about the economy had really and truly set in. So I think that there's kind of no way around the optimism and the confidence that these REIT spokesmen or CEOs have, and I also thought it was interesting their comments about the investment market and where they're investing. They're saying that investment activity picked up. RealPage goes through some of the major acquisitions that are happening, and they're noting that there is more interest in coastal markets versus Sunbelt. They don't mention anywhere else, and that's fine. I don't need anyone paying attention to maybe Midwestern properties that Gray Capital is interested in, but that is a notable,
which
brush
makes sense because the coastal markets we're talking about, like the Northeast, like New York, markets that are seeing good growth. They've been relatively kind of undersupplied. Just technically some are declining population markets, but they're huge markets to operate in. There's tons of liquidity. A lot of these companies are based in a lot of those markets, or it's familiar territory. You're kind of playing on home turf. So it makes a lot of sense. And not only that, just the primary markets have always been the favorite for large institutions, and then also foreign investors. So New York, Boston, Philly, markets like that are going to play continue to play a role. They always have played a big role. Honestly, it was just in the last cycle that the Sun Belt became this like new like sexy thing. Like, people are moving down to the Sun Belt. Let's not just invest in the primary markets. Let's go down south. And that worked out for a lot of people for a long time. It's not working that well right now.
It's interesting. It says most Sunbelt REITs are projecting a return to rent growth in third quarter. I think that's certainly possible, especially on average if you're averaging a certain market, all the markets. However, it is equally likely in maybe 3 or 4 of these very, very popular Sunbelt markets like Austin, that they could continue to see negative rent growth through the end of the year. RealPage themselves, in an April 29th projection, and see, that's where I clicked on it, said, this is consistent with RealPage forecasting as well. Good, I'm glad you clicked on it, because forecasted rent change for calendar 2025, the 3 markets with rent cuts expected. Austin and Phoenix, 2 Sunbelt markets, and Denver those are the 3. And there is just a whole collection of Sunbelt markets that are expected to have rent growth below the national average. So they are crawling out. They're probably all the way maybe crawled out by the early 2026. Who knows?
Could be, yeah.
It's just it will depend on how active the building is there. It kind of continues after the supply wave.
Yeah, I think, that's an open story or open question about, new supply. I think the consensus or the common narrative is we're going to have very little supply. Supply is going to fall off a cliff, as many have said, including ourselves. But the reality is people are still building. And we saw in that report that many of those REITs are still planning a robust pipeline of new deliveries in many of the same markets. We talked to developers anecdotally who are like, no, we still have projects that we want to build. Others who want to build, but they're having a hard time finding the equity to finance it. But I think that's still a question that's out there, and I don't know if it's one that anyone can answer unless someone is able to survey every developer.
I'm guessing there's an overlap between the people that are excited to invest in apartments, pre-existing apartments in Austin, and the people that are excited to build apartments in Austin. So there's always going to be that dynamic, and it will be interesting. And a little bit of this seems like what are the cool kids watching? I want to be a little, you want to be ahead of the trend, but you don't want to be like completely apart from the trend. So there is going to be a dynamic of certain markets receiving perhaps too much attention from developers in a way that leads to a short-term supply. I think that's more short-term oversupply. I think that's more likely in the Sun Belt, and that probably will be just a factor going forward, for as long as they remain at the top of investors' minds.
Yeah, you can have strong population growth, but if you've got the supply coming online to meet it,
and that's relevant for a couple more of these for some of these sources that we're talking about in the going forward in this very same gray report.
So now I want to talk about homeownership a little bit more. Again, there's a new report from Apartment List 2025 Millennial Homeownership Report. Matt, you're a millennial.
Yep,
I'm a millennial. We both own homes.
Squeaked by.
Congratulations.
Squeaked by before
squeaked by.
Pandemic. But that's not all the case for all millennials.
No,
I hate to break it to you.
It's not. No, I think the way you said is exactly the way I feel is that we squeaked by. Kind of got right in before prices got crazy.
Yep.
And when you could lock those rates, I mean, now I would just be looking to rent something that's really nice. Probably wouldn't be thinking about buying something. What does this report tell us about, millennials who would be buying homes, but now they're like, is that an option?
No, Apartment says, and here's the quote to enter this source here: millennials are responsible for a substantial share of home purchase during the past year, but on a per capita basis, homeownership rate for millennials have been growing at a slower rate than that of previous generations. And an early look at Gen Z shows the trend is worsening, not improving. Worsening, not improving. There is a little bit of a caveat in that Generation X is making some gains relative to baby boomers, but it is still the real story is this difference between millennial homeownership and Generation X. That's where the real meaningful gap is. And right now we're looking at a line graph of generational home ownership rates from 1985 to 2024, and silent generation is at 70%.
Still alive.
Still alive. And they have declined, though, because they're moving into...
I'm surprised they own so many homes.
Yeah, exactly.
Well, I guess this is relative. The ones
there's
that are still
aging in
with us.
place, and they're still with us, and 74% of baby boomers, they have exceeded silent generation, and 74% of baby boomers own their homes, 65% of Gen X, and huge jump down. 47% of millennials own homes, and Gen Z 9% own homes, but that's just because they're so young. I think they haven't reached a meaningful homeownership stage yet.
No, absolutely.
But these drop-offs from boomer to millennial to Gen Z, they can be partly explained by that age difference. However, by age 30, and we're looking at this right now, by age 30, 55% of silent generation members owned a home. Jumped down 7% points to baby boomers. 48% when they were 30, they owned a home. Jumped down 6% points to Gen Xers. So that's a smaller jump. So that's what I mean when it seems like Gen Xers are kind of making a little bit of gains. They're converging among those. Yeah. The real gap is millennials. 33% own home. That's 11% difference from Gen Xers. That's the real gap, and it's one that may continue with Gen Z. We'll have to see. I wonder if there's a cluster of those top 3 generations, silent baby boomer, Gen X, and then millennial and Gen Z may be clustered together in terms of
I think the millennials and Gen Zs are going to be clustered. What this shows is that we have more individuals that are renting for longer. For every percentage point, that represents thousands, tens of thousands of renters who would have been buying a home, but now are going to choose to rent something for the next couple of years, which puts more pressure on supply and increases demand overall. And this trend was already taking place as, it was breaking out between generation baby boomers and Gen Xers, but it's been exacerbated. The millennial generation, the great financial crisis, I think kickstarted it, put millennials behind a couple of years. I mean, couldn't get a job, graduating college, and we've talked about that before.
And if you scroll down to the final graph they have in this, it shows how the Generation X, as they got old, they had a much sharper increase in home ownership than millennials. Now, millennials have kind of
by the time they're almost 60.
And millennials have kind of caught up to Gen X, but recently there's been some shakiness. So I don't think that the story is completely told. And that number for millennials, it looks like it's intersected Gen X, but as the millennials age and that average age of the 40-year-olds or the 43-year-olds, that's going to shake out. So I think that the millennials will actually not converge as much with Generation X as as the years go by. So they say that millennial ownership is catching up to Gen X, but I don't think that story is near finished being told. I think that if anything, they could diverge even further. What the real convergence is, I think, is between Gen X, baby boomer, and silent generation. But who knows? I always feel like everything bad is happening to millennials, and some people don't even think enough about Gen X. But it's good to know that at least they're owning homes and they're being, some good things are happening to Gen X. They didn't get all the attention.
But they were a little neglected.
They own all the homes.
They were a little neglected, but they own a decent amount of homes now. Okay, let's keep talking about housing affordability because I think it's a driver for the economy, and I think it really impacts multifamily. And again, on those margins, it adjusts some of the primary variables of how many people will be looking to rent versus buying, which drives a lot of demand.
A couple sources from NAHB, National Association of Home Builders, on that are linked up with the BLS income information, and this one specifically connects the housing market with income growth, saying that actually things are getting more affordable slightly. The cost of housing results from the first quarter of 2025 show that a family earning the median income needed 36% to cover the mortgage payment. That actually, things have improved, and the percentage of a family's income needed to purchase a new home fell from 38% in Q4 2022 to 36% in Q1 2025. That is a result of a 6.5 rise in median family income, which is huge, and a 1% decline in the median price of a new home. So that's really great.
Moving, I guess, in the right direction, but we're really talking about moving around the margins. I mean, it's like people are making a little bit more money, and some homes are a little less expensive. And so for the individuals that were on the cusp, and like some just got a raise, and in their market the house came down, like maybe they're buying a home. But to me, I mean, this is my takeaway was that, like, all right, we need to watch the housing market. See how it goes. Is it going to kind of be steady, plus or minus, to kind of be flat, or we're looking for something, more concerning? But also wages going up, I think generally a good thing. I mean, obviously, you have to be concerned about, a wage price spiral, inflationary spiral at some point. I don't think wages popping up a little bit is going to cause that. They're not growing by leaps and bounds. And if anything, again, that's a good thing. I see this as, relatively positive for housing generally, whether that's buying a home or renting. I mean, I think, renting again is going to be, incomes are certainly the ceiling on what, one can achieve in terms of asking rent. And so
if anything, wages going up, home prices going down suggests that maybe home prices have further to fall. If wages go up, you'd think that home prices would go up as they're more able to buy that home. But interest rates did not change as much as
Yeah.
significantly
that's
between
where
Q4 and Q1. So who knows?
That's why I just don't know. I mean, there is a link, but I just don't know if it's that strong. If someone's wages go up, marginally,
Yeah.
they either were in the market to buy a house or they weren't.
Yeah.
Yeah,
I think that they haven't gone
You
up
clearly can
to make
afford
it more
it.
affordable to everyone. I think that the big thing is people see that high price of homes, and there may be a little bit more softness in the for sale home market moving forward. That's at least my kind of thing I talk about on the weekends when people are asking about the housing market. It's like, well, it's not, and there is an outside chance that home values could go down in 2025. I don't think it's I don't think that they're going to completely plummet, but I would.
No, but I was in an area just curious to see what the home values were in that area, and there were a couple houses, just a list, like very small sample size, but there were a handful that had gone through a price cut. And again, that real small anecdote, but I don't think we're on loose footing. I think it's delicate.
Yeah,
it's
and
delicate
that
ground.
speaks to the relevance of the bond market a lot, because I think that this is largely it could be, we're just fed up with these high home prices, but what really they're fed up with having to pay a high home payment. The idea of a high home payment,
exactly.
And like if if mortgage rates go down, then things will get a lot more exciting for home buyers in the future. But I think that's the shift that would really revive it. If rates go up,
what if mortgage rates go up even more?
Then we're gonna get a little bit different articles from NHB, and we'll probably, I don't know.
Well, that's why we started the show talking about.
Yeah.
Those bonds. Again, it's not something that's really happened. I mean, I think the 10-year yield was down today because, pivoted on EU tariffs or something.
Yeah.
But, fundamentally, if those bond yields increase materially, now that, if we're talking about a 5.5, yield on the 10-year treasury, or 6% yield in the 10-year treasury, and so we're dealing with mortgage rates and they're like 9%.
That'll factor in with home buying decisions. That'll factor in with investment decisions. That'll factor in business decisions. It's something worth talking about. It's something that people should be thinking about as well.
Yeah, it's not necessarily like, I don't even think it's necessarily going to happen, but just the fact that it's on the board, worth watching for. And if you're thinking about buying real estate right now, commercial real estate, you have to be thinking about, if you're buying just a 5 cap,
It's super interesting that, like past maybe 3-ish years ago, or maybe even a couple of years ago, we were thinking so much about Jerome Powell, and this year it's like people kind of know what to expect from Jerome Powell and the Federal Reserve, more or less. And it's really the 10-year Treasury that's been
it's been
wild.
Fed's wait and see. Wait and see. Nothing.
That's
nothing they can do. There's just not enough information. And it's been driven by tariffs and trade and uncertainty and volatility and the press conferences have been like, we're going to figure it out, take it meeting by meeting as the data comes in.
So but I will note that the employment situation may be different in different places. If I can make a good segue here, and another Real Page article saying that job losses have persisted in the Bay Area and Midwest markets. Don't worry, I've got a rejoinder. I've got some responses there.
I wasn't too worried after reading.
Yeah. The first thing I said is like, is everything we've said about the Midwest wrong? No, because I looked into the BLS numbers. I looked into the month-over-month and the year-over-year numbers that they have, and even though they say that several Midwest metros have experienced mild employment losses, including St. Louis, Kansas City, Des Moines, and Milwaukee, they are. It is nothing catastrophic. It is more like it's still worth it if you're an investor to look at the supply and relative growth and like let's look at the absolute unemployment rate for some of these places, because there may be some moderate employment losses in the near term, but overall, like these are places with very low unemployment.
3-4%, very low unemployment.
They also say that the markets with the biggest employment numbers are almost all on the East Coast or in the South, and many of the largest cities are in like a top 10 list, which is so these are the biggest numbers, which is New York, Houston, Dallas, Philly, Charlotte, Orlando, DC, San Antonio, Salt Lake City, Miami, in that order. It's funny they say DC, because I'm about to talk to you about how the percentage of their, I'll get into it later, but DC as a district is actually percentage-wise their employment is not looking so good. So if you're going by nominal numbers, it can be a little bit shaky. And you'll always see like a Dallas as huge.
Yeah,
numbers,
Dallas and New York are always going to be on top. I mean,
Yeah.
Houston, these massive cities.
But like by percentage, things are a little bit different. And the fact that DC numbers I'm just pulling out because it does directly disagree with some of the information from the BLS about and they're comparing it to different states. But basically, the DC may have had a lot of jobs, but their employment numbers are less than are comparatively less than other places. My point, though, in showing this is that like there is a difference between those raw numbers, and you got to look at the job change percentages. And they do have some here in this real page where it's Myrtle Beach, Charleston, Urban Honolulu. Tell me if you recognize a pattern here too. Charleston, Honolulu, Huntsville, College Station, Texas, Fayetteville, Arkansas, Jackson, Mississippi, Salem, Oregon, Charlotte, Salt Lake City. Where are they?
I don't know. Do you tell me that?
I think they're in a belt around the sun belty kind of south. Mm-hmm. A lot of these hot markets that people are still really interested. Salt Lake City is not necessarily in the sun belt, but I would often group it in those because of its strong job growth, and it had a lot of attention from apartment builders and apartment investors. These are the places where they're building a lot of apartments. Maybe not as many in some of these as others.
That's why they were building the apartments.
But yeah, this is why. Growth. I also would caution people and say, like, these aren't necessarily going to be the winners for apartment investment because supply is still relevant in this. There's still a I don't want to say oversupply, but there's still a lot of construction activity happening in the South that may make the dynamics such that job growth is not a guarantee of investment success.
Yeah, but our markets that, if you are an investor, in these markets or looking at these markets, definitely worth paying attention to because, there will get to be a point of where prices make sense in some of those markets. There is good growth. And if they had recently been oversupplied and prices come down and even rents are down, you have an opportunity to come in, buy something at a high cap rate, low price while growth has been slow. And then that growth picks back up when supply comes down. Yeah. I think could be in a very advantageous
for sure
strategy.
Yeah. And the unemployment, like I said, and there's a map that I brought up from BLS in another tab for the unemployment rate for each state. And it's not exactly like you see all of the unemployment happening in the Midwest and all of the, strong job growth in the South. It's a little bit mixed up. However, there's some higher unemployment in places like Ohio and Michigan. That contrasts with Indiana and Iowa and Nebraska. So South Dakota is 1.8%. That is technically
everybody's working in South Dakota. I think wasn't it New Mexico? I guess these are unemployment rates, but in New Mexico on let me see if I can find the map there. I think there was 14%. Construction job growth.
Oh yeah, that's in the next tab.
That's in the next tab.
Yeah. All right.
Yeah,
Let's skip to this.
Sorry to be
It's another
skipping
NHB
around
article.
so
No,
much.
it's fine. And we may need to refresh the tab here.
Yeah, that's okay.
But this NHB has the employment and the percentage change. That's what I really wish they had for the market level for RealPage is the percentage change of employment. And again, it doesn't necessarily show that like, oh, they're bleeding jobs in the Midwest. It's just relatively stronger in the Sun Belt, and but not by much, really. We're talking by a couple tenths of a percent, if that. There were three states as a whole, where the year-over-year percent change was negative. They were Iowa, West Virginia, and Washington, D.C.
There we go.
But when you're talking about monthly changes, there actually was around 10, I think, for that had month-over-month changes. They note that in the paragraph, and I just chased down the BLS tables because that's kind of added value I like to add.
Yeah.
The 9 states plus D.C. with employment losses are Arkansas, D.C., Minnesota, Missouri, Montana, New Hampshire, New Mexico, Vermont, Wisconsin, and Alaska. Across the board, there's a lot of different places. So they're not necessarily clustered in a region. However, like maybe not as many Sunbelt. I do think, it's worth noting there is strong job growth in the South. It's not just like we're saying, oh yeah, it's oversupplied. We'll use Austin as an example to say, hey, everyone should invest in the Midwest. Well, it's a lot more complicated than that, and there is a really compelling reason why all these people invest in there. It's because it's really hard to find a low number for job or population growth in any of these Sunbelt states.
No, well said. Very, very true.
Yeah.
What are we doing now, Matt?
For what?
What are we doing now?
Oh no, that's
Is this it?
Yeah, this
Sorry,
is.
pause. Just make note. I wasn't sure.
Yeah,
of the transition.
but if you want to learn more about the Midwestern resilience and about some of these Midwestern markets that we only briefly touched upon in our coverage of nationwide apartment markets, you can go to www.graycapitalllc.com/Midwest-report or go to graycap.com and click the button link. There'll be a really handy. Graycap.net.
Yeah,
and click the button
graycap.net.
link on the report, and it'll send you straight to it, where you can learn more about some of the key markets that we think exemplify the stability and resilience, and I think sane supply trends and construction trends that make the Midwest a really that make us. This was the confidence that I was talking about. We know a lot about these Midwestern markets. We're confident in it, and we're confident based on the data of them being able to survive a lot of turbulent periods, much like the one we're in right now. So that's my little plug, and that's hopefully.
Well,
some explanation.
some people say the Pacers, Matt, have been the most underrated team.
There you go.
NBA.
Yeah, exactly.
And I think the Midwest has probably been the most underrated region in the multifamily market, with Indianapolis probably being one of the most underrated multifamily markets in the entire country. So there's just a lot to. It's important if your interest has been sparked in the Midwest to take the next step and to start becoming familiar with these markets. Because what I hear from a lot of people that aren't from the Midwest, never been in the Midwest, they just don't know much about it. Yeah. They maybe know a little bit about it. They're like, okay, I know the Indy 500 is there, which if you haven't ever been to an Indy 500, and if you have ever questioned what culture in America looks like, well, it's peak culture. Yeah. Peak American culture. It is a beautiful event. The entire month of May is just an incredible place to be here in Indianapolis. And so if you're there listening saying, I just don't know that much about that market or these markets. Yeah. I've heard that they're good. I'm interested. I was there for one time on business real quick, or, my cousin got married there and I went to a wedding 15 years ago. Yeah. The Midwest Multifamily Resilience Report is kind of that first step to be able to get a good intro into why these are compelling investment markets for multifamily. So Matt is absolutely right. Go to graycap.net, download the report, start digging in, and schedule a meeting with us. Our investor relations team is available 24/7, basically, to have a conversation with you and want to learn kind of about what your objectives are, what you're looking to do. If you're an accredited investor, we'd love to talk to you about any upcoming opportunities. But even again, as we talked about, it's a challenging time to find deals. We don't have an active deal right now because, we're being very patient and highly selective. We haven't closed on a deal all year. And good chance we won't because we don't find the right opportunity. Rather be patient, make the right calls. If you want to just get in touch with us, kind of get onboarded, learn about what we do, ask some questions about the Midwest, the deals we're in, markets. We do our own property management. We're vertically integrated, all that. Get in touch with the team. Find it all at graycap.net from the report. Schedule a meeting. We're here to help. Oh, yeah. All right. Thanks for watching this episode. Make sure you're subscribed to the Gray Capital YouTube channel. If you're not, it's really easy to do. There's a bell icon so you can be notified for all the latest releases from the Gray Capital team, Gray Report episodes. Leave a comment below. We will get back to you. Oh, yeah. We'll comment back, and we'll say hi. We appreciate you. Catch you on the next one.